In part one, we talked about mindset. Now we need to understand what you are actually trading. Because if you do not understand the pair, the pip, the spread, and leverage, you can lose money before you even know what happened. These are the mechanics of the game. Let's get into it. Quick recap. Mindset first. No clicking from boredom. We think in sample sizes. And most importantly, we demo first. Now let's learn the game board. Forex stands for foreign exchange. It is the largest financial market in the world. You are not buying a company like a stock. You are comparing one currency to another. It's a global tug of war between the economies of different nations. Currencies are always traded in pairs. Let's look at the most popular one, EUR/USD. The first currency, EUR, is the base. Think of this as the one unit of stuff you are buying. The second, US dollars, is the quote. It shows how much of that currency it takes to buy one base unit. So if EUR/USD is 1.0850, 1 euro is worth about $1.08. When you buy EUR/USD, you are technically buying the euro and selling the US dollar. You want the euro to get stronger compared to the dollar. If it goes up, you're winning. If you buy at 1.0850 and it rises to 1.0900, that trade moved 50 pips in your favor. Selling EUR/USD is the opposite. You are selling the euro and buying the US dollar. In this case, you want the euro to get weaker. You make money if the price falls. If you sell at 1.0850 and it falls to 1.0800, that is another 50 pip move in your favor. Think of a currency pair like a scoreboard. EUR/USD going up means Europe is winning. If the pair goes down, it means the US dollar is winning the match. Simple, right? Now, which pairs should you watch? We start with the majors. These involve the US dollar. These include the pound, the yen, the Swiss franc, and the Australian and Canadian dollars. We trade these because they have more liquidity and tighter spreads. They are much easier to learn. Avoid exotic pairs at first. These are currencies from smaller or developing economies. They have huge spreads and can make massive, unpredictable moves, not for beginners. So, what is a pip? It stands for percentage in point. It's the smallest unit of price movement. For most pairs, it's the fourth decimal place. Moving from 1.0850 to 1.0851 is 1 pip. If it moves from 1.0850 to 1.0900, that's a 50 pip move. This is how we track our results. Japanese yen pairs are different. Here, a pip is usually the second decimal place. So moving from 157.20 to 157.30 is 10 pips. Don't worry, you don't need to memorize it all now. Quick quiz. If EUR/USD moves from 1.0850 to 1.087, how many pips is that? The answer is 20. Next, GBP/USD 1.2700 down to 1.2650. How many pips? That's 50 pips down. Last one, USD/JPY 157.20 to 157.50. That is 30 pips up. What is the spread? It's the difference between the buy price and the sell price. This is how brokers make money. When you enter a trade, you start slightly negative. Smaller spreads make trading cheaper. High spreads make it harder to become profitable. Now, let's talk about leverage. This lets you control a large position with a small amount of money. It's a double-edged sword. It magnifies your wins, but it also magnifies your losses fast. The danger isn't the chart, it's your position size. Leverage isn't free money. Margin is just the money your broker holds as a deposit to keep your leverage trade open. We control size using lots. Standard, mini, and micro. Most of you will start with micros. Never choose lot size first. Think about the dollars you are willing to risk first. If you have $1,000 and risk 1%, that's $10. That is your limit. Your lot size must be small enough, so a 50 pip loss only costs you those $10. You make money when price moves in your direction enough to cover costs and hit your target. The job isn't to be right every time, it's to risk small and let the good trades pay more. This is why we demo. Learn the buttons, the spreads, and the risk without losing real money. Recap. Pairs are currencies. Pips measure movement. Spread is the cost. Leverage magnifies both ways. Your assignment, open a demo. Pick 3 pairs. Write the base and quote. Track movement for 3 days. You've mastered the basics. In part 3, we build your watch list. See you there.